Okay, this is chapter 10, balance of payment. So balance of payment is basically a systematic record of all economic transaction of a country with the rest of the world. Okay, so whenever you have open economy, then you make transactions with the rest of the world. And for this, we keep balance of payment. So it's a systematic record of all economic transactions that a country makes with the rest of the world. Okay. There are some other transactions that cannot be included in balance of payment, like smuggling. Through smuggling, there are some transactions. So because there is no record, so this transaction cannot be included in balance of payment. Now, in balance of payment, uh, each international transaction enters twice. So double entry bookkeeping system is there. So we have credit and debit. So credit entry is with positive sign and debit entry is with negative sign. Okay. So how to enter the transaction as a credit transaction? So any transaction that involves receipt from the foreigner. So if you are receiving uh, money from the foreigner for the as a result of any transaction, so that transaction would be considered as credit transaction and it will be entered into balance of payment with positive sign. For example, if we export goods, then we will get payment for our exports. So that transaction will be recorded as credit transaction with plus sign in the balance of payment. Okay. And there are also some financial inflows. So if there is increase in foreign assets in a nation, so if we are selling bonds to foreigners, then there will be a receipt of payment from foreigners that would be included as credit transaction. And if there is a decrease in nation's asset abroad, so if we are selling our bond, again there will be a receipt from foreigners, okay, and that would be recorded as credit transactions. And in case of debit transactions, we have to make payment. So any transaction that involve payment to foreigners, okay, that will be recorded as debit transaction with negative entry. And if we suppose import a good, if we import a car, then we have to make payment, and this would be recorded as debit transaction with negative sign in balance of payment. And there are financial outflows, so increase in nation asset abroad. So if we are increasing our assets some other countries, so we have to make payment. So this would be regarded as debit transaction. And a decrease in foreign assets in a nations. So again, if foreigners are selling their already purchased bond, which are our bond, so again we have to make payment against those bonds. So this would be recorded as debit transaction, and it will be entered with negative sign in the balance of payment. And we have three broad accounts in balance of payment. We have current account, we have financial account, and we have capital account. Now current accounts, this records the flow of goods and services, okay, and export and imports. And then we have financial accounts. This records the flow of financial assets, okay. And then we have capital account, which records the flow of special categories of assets, okay, non-market and non-produce or intangible assets like debt forgiveness, or copyright, or trademarks related transactions. But mostly we have current account and the financial accounts. Okay, this is the example of double entry bookkeeping system in the balance of payment. Okay, so you import a Japanese car by using your debit card, So if you are suppose a national in Bahrain, okay, so then the Japanese producer of a car deposit the funds in its Pakistani bank account, okay, then this would be recorded as, you know, debit transaction. Now double entry, so car purchase would be a part of current account, and if the suppose the price of car is 8,000, so then you have to make payment of 8,000 US dollar. Okay, with negative sign there will be entry, and then there will also be an entry of positive 8,000 because it would be credited in your bank account. Okay, in suppose Islamabad, or if you are Bahraini national, then Manama, it has a bank account, suppose. So in this way, we make entry. This is another example. Let me show you. Again, if you invest in Japanese stock market by buying 5,000, worth of Sony stocks, then this is a purchase of stocks. So whenever you purchase stock, then it means you have to make payment, and this payment would be a debit transaction, and it will be enter minus, suppose, minus $500 in the financial account. Now again, there would be a plus $500 because this Sony company will deposit your fund in your bank, in your country's bank. Okay, so if you are Bahraini, then maybe bank in Manama, or Pakistani, then bank in Islamabad or Karachi. So, and then bank credit the account by the amount of the deposit. So then again in the financial account there will be entry of plus $500. Then suppose the Pakistani bank, forgive $100 million debt which is owed by the government of Somalia through debt restructuring. Now, Pakistani banks who hold the debt thereby reduce the debt by crediting Somalia's bank account. So debt forgiveness would be a part of capital account. Okay. This is non-market transfer. So minus 100 million, and then again because it is a sale of bank account by your side, so it will be a plus 100 million account, okay, in the financial account. So balance of payment, accounting is a very complicated accounting system, and if you look at the entire system, so there are many transactions, and sometimes it is difficult to compare which transaction would be part of which accounts, and then we have a manual of balance of payment account. IMF published that, and then there are details available, but still just like system of national accounts, national income accountings, we have United Nations system of national accounts, and there are work on it how to improve that system. Same is with the balance of payment. Okay. We have current accounts where we record the imports and exports of goods and services, and then income receipts. So merchandise trade is a part of current account. Okay, and the services trade for payments of legal services and shipping services and all these. Then income receipts, interest and dividend payment and earnings of firm, profit. Profit is also a part of current account. Interest payment receipt is also a part of current account. Dividend payment receipt is a part of current account. Okay, and worker remittances. Okay, so workers, they are operating in foreign countries, so they send money to their country. So this would be a part of current account. And we have net unilateral transfers. Okay, which include the gifts and grants, all these things. Okay, so and they do not purchase the goods and service. Okay, so they are just unilateral transfers. Okay, so this would also be a part of current account. Then we have capital account. Okay, so this record special asset transfer, but this is a minor account in most of the countries. Okay, then we have financial account. Financial account is a major account again. Okay, so financial accounts, we have financial flows. Okay, we have sales and purchase of financial assets. We have domestic assets, then we have foreign assets. We can sell domestic assets to foreigner, and then we can buy foreign assets. So domestic residents can buy foreign assets. So then we have financial inflows and outflows. Okay, so foreigners loans to domestic citizen by acquiring domestic assets. So if you are selling your bond to foreigner, so this means you are getting loan from foreigners. They will get the bond and then they will make a payment. Okay, so this is financial inflows. And then foreign on sold asset in domestic economy. Again, if you are holding foreign asset, suppose you are holding US bond, and then if you sell it, then again there will be inflow. Then we have financial outflow. We have domestic citizen loan. If we are giving loan to foreigners, okay, by acquiring foreign assets, and then domestically owned assets in foreign economies are, you know, debit. So again, financial outflow. Okay, if you are buying foreign assets, okay, then again it means you have to make payment. So this would be a financial outflow. So financial accounts, we have three categories. We have official international reserve assets, we have all other assets, and statistical discrepancy. There will be a statistical discrepancy because data is coming from transaction, and there could be a difference in coverage, accuracy, and timing. Okay, that's why there is always statistical discrepancy in balance of payment account, because balance of payment is always balance. Okay, so if we sum current capital and financial account, this must come zero. So if it is not balanced, then we have to make it balance by introducing statistical discrepancy. So in developing countries, statistical discrepancy is large because there are some transactions that are not properly recorded, or there are lags in transaction. There are issues of accuracy, and also documentation problem is there. So there is big statistical discrepancy. But in developed countries, statistical discrepancy is small because they are well documented. So, but statistical discrepancy would be there, okay, because to make it balance. So normally, balance of payment accounts seldom balance in practice. So we don't get to balance in balance of payment account. So after introducing statistical discrepancy, then it is balance. So we have official reserve assets. These are the foreign assets held by central bank to cushion against instability in international markets. So these assets include government bonds. We have foreign currency. We have gold. Okay, and then we have SDR, special drawing rights of IMF. So the official reserve asset owned by sold to foreign central banks are credit, and the official reserve asset owned by or purchased by the domestic central bank are debit. So when you are purchasing, it means you have to make payment. So this will enter as a debit in the balance of payment account. So if you are selling official reserve assets, so this means it will enter as credit because you will get receipt from foreigner. So you have to remember any transaction that result receipt from foreigner would be a credit transaction and it will enter as positive with positive sign in the balance of payment. And any transaction which leads to payment to the foreigner, this will be a debit transaction and it will enter as a negative sign. This is the example. Okay. Very aggregated and very simple example of balance of payment. In reality, balance of payment is very complicated. Okay, but here just to learn some major accounts, you can see that we have merchandise exports. This is $8,875. So this is export, so it has entered with positive sign, and merchandise imports negative sign. Okay, and then export of services, because this is export, so it will result receipt. So here, and then imports negative, income received. So you have to remember that income received and income paid. Okay, so income received is positive, income paid because this is a payment, so this will enter as a negative sign. And this is unilateral transfers, grants and donations. Okay, so this is positive, so it means there is a receipt. And the change in national asset abroad, which is negative, and change in foreign assets, which is positive. So it means foreigners are holding our assets, and then national residents are holding less foreign assets compared to this. And there is a statistical discrepancy. You can see that there is a statistical, and then change in official reserves. So there is a decrease in official reserve. Now we can calculate different account. So if we want to calculate merchandise trade balance, so this is just export minus imports. Okay, just write down this and then we will calculate. Just write down merchandise trade balance formula. This equals export of goods minus imports of goods. Only goods. Then we have trade balance. Okay. So in case of trade balance, we have export of goods and services. Now you can see that we have also included services. So merchandise trade balance will not include services, but the trade balance will include the trade in goods and services. So that's why we have export of goods and services minus imports of goods and services. So you have to write down this trade balance equals export of goods and services minus imports of goods and services. So from this table, we will calculate all. So you have these figures. So we will calculate merchandise trade balance. You will get the number, and then trade balance. You will get the number, and then income balance. Okay, how to calculate income balance? This is simply income received minus income paid. Okay. So write down this also. Income balance equals income received minus income paid. Then we have current account balance. So current account balance equals trade balance. From here you will get trade balance number, and then we have income balance. You will get income balance number here. You have to, and then unilateral transfer. So these are the unilateral transfer. Grants and donations. These are unilateral transfer 205. Write down this also. The current account balance equals trade balance plus income balance plus unilateral transfer. Or you can take a screenshot. And we have financial account balance. We have to, this equals, change in national asset abroad and change in foreign asset plus statistical discrepancy. So we have this change in national asset abroad, change in foreign assets, statistical discrepancy. So if you add all these, you will get financial account balance. And then official reserve transaction balance is simply you have to add current account and financial account. These two accounts, if you add, you will get official reserve transaction balance. Take a screenshot of this